We begin with Chapter 12. In this chapter, we will analyze in detail the bear-put spread strategy. The bear-put spread position is used when the market outlook is slightly bearish to bearish. The strategy consists of buying a put and selling another put with a lower strike price. Both options must have the same expiration date. Here we can see the risk graph of the position. What we are seeing is a graph with two axes. On the vertical axis, the profits and losses of the position are indicated, and on the horizontal axis, the stock price is indicated. It is important to mention that the graph indicates the profits and losses per share on the expiration date of the contracts, and besides, the values do not include brokerage commissions. The debit paid to initiate the position is given by the difference between the premium of the long put and the premium of the short put. That is, it is the difference between the premium paid and the premium received. As the short option has a lower strike price, the premium received is lower than the premium we must pay for the option with the higher strike price. The maximum profit on this strategy is limited. The most we can make is equal to the strike price of the long put minus the strike price of the short put minus the debit paid multiplied by the number of shares. On the other hand, the maximum loss that we are exposed to is also limited. The most we can lose is equal to the debit paid multiplied by the number of shares. The break-even point is equal to the strike price of the long put minus the debit paid. The break-even point defines the profit and loss zones. In our case, for stock prices lower than the break-even point, we are in a profitable situation. In contrast, for stock prices higher than the break-even point, we are in a losing situation. Continuing with the analysis, the initial margin required to open the position is equal to the 100% of the total debit paid. The effect of volatility depends on the chosen strike prices. With respect to time decay, its effect also depends on the chosen strike prices. On the other hand, with respect to exit conditions, to close the position, we must sell the long put, that is, the higher strike put, and buy the short put, that is, the lower strike put. If the stock price is lower than the break-even point, we are in a profitable position. Otherwise, we are in a losing position. The bear-put spread strategy is part of the family of vertical spreads. They combine a long and short position in call or put options. The options have the same expiration date and different strike prices. This difference between the strike prices is what is known as the spread. In this graph, we can see the influence of time decay on the position. On the vertical axis, the profits and losses of the position are indicated, and on the horizontal axis, the stock price is indicated. The blue curve indicates the profits and losses at trade initiation. As we get closer to options expiration, the curve of profits and losses is like the one shown in green. And finally, at options expiration, the curve of profits and losses is the one shown in red. For this strategy, the effect of time decay will depend on the chosen strike prices. Let's see an example of how this strategy works. Here we are seeing the stock chart of the Amazon company. As we can see, on February 14, 2011, the company gave us a clear bearish signal because the stock touched resistance and was accompanied by a decline in volume and an RSI above 70%. As we said, on Monday, February 14, 2011, Amazon gave us a clear bearish signal. In order to take advantage of that, suppose at that time we had decided to enter a bear put spread. At the close of that day, Amazon was trading at about $191, while the options expiring in March 2011 had a premium of $6.5 for the 190 strike puts and $2 for the 175 strike puts. Thus, we could have bought 2 puts with a strike price of $190 and expiration in March 2011 at $6.5, and sold 2 puts with a strike price of $175 and same expiration at $2. With the 2 contracts, we would be in control of 200 shares. So the bear put spread would have cost us $4.5 per share, that is, $900 overall. The maximum profit is given by the difference between the strike prices minus the debit paid, in our case, 190 minus 175 minus 4.5, which is equal to $10.5 per share, that is, $2,100 overall. A few days later, the stock started to fall until it reached the price of $180 on February 22. It is important to mention that when trading a bear put spread, we must consider the following points: reward to risk ratio, strike prices, and market outlook. With respect to the reward to risk ratio, a 2-to-1 ratio or higher is recommended. That is, we are willing to lose $1 in order to make $2. Regarding the strike prices, in general it is recommended that the 2 contracts are out of the money. And regarding the market outlook, if we expect a sharp fall, instead of entering a bear put spread, it is recommended to buy only the put, that is, open only a long put position. In our case, notice that the maximum profit is $2,100 and the maximum loss is given by the cost of the bear put spread, that is, $900. Therefore, we comply with the recommendation of a reward to risk ratio of 2-to-1 or higher. Also note that both the long put and the short put are out of the money. As we had said, we initiated the trade on February 14, the day we got the bearish signal, and a few days later the stock started to fall until it reached the price of $180 on February 22. At that time, the premium of the 190 strike put was $12.5 and the premium of the 175 strike put was $3.5. If we had closed the position at that time by selling at 12.5 and buying at 3.5, we would have received a credit of $9, so our profit would have been $4.5 per share, because we had placed the trade at a debit of $4.5 per share. Thus, we would have had a total profit of $900, making a 100% return on investment in only 8 days. That is, we made $900 by investing $900. If we had bought only the 190 strike put, we would have made a 92% return on investment, as we had bought at 6.5 and sold at 12.5, making a profit of $6 per share. That is, we made $1,200 by investing $1,300. So, with the bear put spread, we would have made a higher return than the one made by buying only the put. After February 22, the stock continued to fall until it reached the price of $169 on March 1st, touching the 1-month support. The bear put spread is indicated when we expect a fall in the stock price up to the strike price of the short put. Thus, with this strategy, we usually increase our return with respect to buying only the put, because the net cost of the long put is reduced by the premium received for the short put. As we had said, after February 22, the stock continued to fall until it reached the price of $169 on March 1st, touching the 1-month support. At that time, the premium of the 190 strike put was a little more than $21, and the premium of the 175 strike put was $8. If we had closed the position at that time by selling at 21 and buying at 8, we would have received a credit of $13, so our profit would have been $8.5 per share, because we had placed the trade at a debit of $4.5 per share. Thus, we would have had a total profit of $1,700, making a 189% return on investment in only 15 days. That is, we made $1,700 by investing $900. If we had bought only the 190 strike put, we would have made a 223% return on investment, as we had bought at 6.5 and sold at 21, making a profit of $14.5 per share. That is, we made $2,900 by investing $1,300. In this case, it would have been more profitable to have bought only the put. Here we can see the numbers of our example. The strategy consisted of buying 2 Amazon puts with a strike price of $190 and expiration in March 2011 at 6.5, and selling 2 puts with a strike price of $175 and same expiration at $2. The debit paid is the difference between the premium paid and the premium received. In our case, 6.5 minus 2, which is equal to $4.5. Therefore, our investment is equal to 4.5 multiplied by 100, which is the cost of the strategy per contract, multiplied by 2, which is the number of contracts. That's a total of $900. This money is debited from our account. The initial margin required is equal to the 100% of the total debit paid, that is, $900. This is the minimum amount of money that must be deposited into our account in order to open the position. The maximum profit we can make is equal to the strike price of the long put minus the strike price of the short put minus the debit paid multiplied by the number of shares, that is, $2,100. On the other hand, the maximum loss that we are exposed to is equal to $900, that is, the total debit paid. The break-even point is equal to the strike price of the long put minus the debit paid, in our case, 190 minus 4.5, which is equal to $185.5. Here we can see the order we must enter to open the position. It is an order with 2 legs. Leg number 1 corresponds to the long put and consists of buying 2 Amazon puts with a strike price of $190 and expiration in March 2011. Leg number 2 corresponds to the short put and consists of selling 2 puts with a strike price of $175 and same expiration date. The entered price is given by the difference between the purchase and selling prices, that is, the premium paid minus the premium received. In this case, 6.5 minus 2, which is equal to $4.5. This is the money expressed per share that will be debited from our account when the order is filled. The bear put spread is also known as long put spread, and in the family of vertical spreads is part of the debit spreads, since a debit is required to open the position. On the other hand, here is an example of the order we must enter to close the position. It is an order with 2 legs. Leg number 1 consists of selling the puts we had bought. Leg number 2 consists of buying the puts we had sold. The entered price is given by the difference between the selling price and the purchase price. In this case, 12.5 minus 3.5, which is equal to $9. This is the money expressed per share that will be credited to our account when the order is filled. A bear put spread can also be sold short. In that case, the strategy is called bull put spread or short put spread. It is a credit spread. The strategy consists of selling a put and buying another put with a lower strike price. Both options must have the same expiration date. The risk graph is similar to the bull call spread, but as it is a credit spread, the maximum loss that we are exposed to is usually higher than the maximum potential profit. So the short put spread is not recommended because in the case of working with vertical spreads, the best choice is to do so with those that expose us to a profit higher than the loss. Here we ended with the chapter Bear Put Spread. In the next chapter, number 13, we will analyze in detail the long straddle strategy.